Good afternoon and welcome back to the weekly market analysis for the week ending March 8th, 2024. And the question today is, are we at the beginning of a correction in risk assets? And then beyond that, which assets are potentially going to be correcting? Starting here on the SMH, which is the semiconductor ETF. This is one of the semiconductor ETFs. We'll jump into it in just a second and analyze it starting with this, but I'd like to just remind you to hit the like button and subscribe to the channel. You can also find me on Twitter at Mr. J. Thomason, or follow my free weekly newsletter at befinanciallyfree.substack.com. The newsletter comes out every Sunday morning, so you could be looking forward to that every week. I do much more thorough analysis after a weekend of homework and analysis on the markets, and so you could check that out. So starting off here, looking at SMH, and we had a huge outside reversal to the downside today. This, to my recollection, is the first outside reversal, bearish outside reversal that we've had on the semis in, I can't even remember how long ago we had one of these, and this is the worst single day for the semiconductors since back in December of 2022, and I believe it was right here. The last time we had a drop of more of the same or more than what we had today in semiconductors, it was December 2022, and so that's obviously a pretty telling thing. We had a lot of down days like this, obviously, during the bear market. The last time I think that we had an outside bearish reversal in the market, man, I don't even know. I think I see one. No, that's not one. I don't even know. It's been a really, really long time since we've seen one. And obviously, when I say a bearish outside reversal, the best example that I can find is out here at the when we had the top back in November of 2021 on the Nasdaq. You can see here on November 22nd of 2021, price went up really high above the previous day's high, and then actually closed down not only below the open of the previous day, but below the low of the previous day. And actually, this was the I don't think. Let me look. The high was 159.35 later in January. Yeah, so we didn't make a higher intraday high from that moment. I'm not saying that we're about to begin a bear market like we did in 2022, but I do think it is notable. You have to trade the market that's in front of you. You have to trade the signals that price tells you. And price having this kind of day today, it means something, I think. And so let me start off by just saying that from a technical standpoint and from a sentiment standpoint, I think assets are set up right now for a correction. From a how can I say? From a positioning standpoint, there's no reason to expect that there is going to be a correction right now. So we're going to try to look at that in just a second. But I did want to start off with the SMH because this is obviously the big one that dropped today, which was minus 3.92%. If you look at the NVIDIA chart, the NVIDIA itself dropped 5.55%. And again, same thing. I couldn't tell you the last time we had an outside bearish reversal day. I mean, probably that same day, if I were to go back and try to find that same spot, it wasn't even an outside reversal day. Obviously, single stocks is a little bit different. I think the last time we had an outside reversal day was not even back in August of 2022. It's been a really, really long time. So I think that means something, at least in the near term. And obviously, just because price may be correcting, I'm going to have to adjust this. Just because price may be correcting does not mean that there must be that this is going to be the start of a bear market. I mean, if we just start on S&P 500 here, and we get our little line here, our info line, If we drop 10%, which is what counts as a correction, we're still above 4,600. And we still have, the previous all-time high support below us. We have pretty, well, actually, I need to get rid of this line. I think this is set because I have it set to contract adjustment. Yeah. So it's a little bit hard with futures because you get the contract rolls, and so right now it looks like this was a huge gap up. But essentially, if I go from the high, then a 10% drop puts us at 4,700 if we're looking at the S&P futures front contract. And then, like I said, we've got the previous all-time high. We've got pretty solid support at 48.33, at least as I'm reading it here on the futures. So that is something to take note of. What often happens is especially when you're in price discovery making all-time highs, everyone is looking for the reversal, and then once price does start to correct, you get people getting way too bearish. And look at how far back do we have to go? Of course you get bear markets periodically, you get exogenous events, but right now there's no reason to expect that we're going into the early stages of any sort of market meltdown or anything. A correction would be normal here, and honestly, frankly, after the run that we've had since late October of 2023, it would make sense for price to get to have a little bit of a pullback here. So that could be anywhere from 5 to 10% would be totally normal. Again, so I want to take a look at some technical reasons why we could see a correction. So again, it's a little bit wonky because of the nature of the contract rolls. But if you go off of, if I'm looking at the current futures contract, this is going to be the 1, 2, 3, 4, 5th time that we're getting a MACD histogram bearish divergence. We've got our 4th consecutive RSI divergence as we're making higher highs. So we've got we were pretty close to being overbought today. We would have been overbought had we actually gone up as high as we did. So there's that. If you look at the NASDAQ, which obviously is much more concentrated in tech, and tech has been largely leading, not the only one coming up, but largely leading this rally. The technical divergences are even more pronounced, and obviously, excuse me, not every divergence has to resolve in an expected way. But I will say that I think it is a big deal. These kinds of divergences can only go on for so long, and so it doesn't surprise me at all that we got a down day today, and we could see a prolonged. If this plays out, we could see a prolonged consolidation and backfill. So I would say that as well. Other reasons in terms of intermarket relations, we haven't been seeing a whole lot of follow through from the Dow. So if I do again the contract adjustment so that you can see it more uniformly, this chart on the Dow does not look anything like the S&P chart, which has basically been in a straight line, or in the NASDAQ, which has been basically a straight line. And then obviously we've got the Russell, which is behaving in its own way too. So we're largely not seeing the type of price action that across every single index that would confirm the right kind of behavior in markets. So I do want to be apprised of that reality. Excuse me. So we'll just turn that off again for a second. Other things that I want to think about, or that I want to point out today. VIX had an up day. We haven't had a lot of Fridays where the VIX was up. In fact, I can't remember the last time the VIX had a green day. I guess on the 16th of February. But before that, lots of Fridays where the VIX just melted down. So VIX elevated going into the weekend, I think carries some weight in terms of the setup going into next week. Let's see. I'm trying to remember what else there was. Oh yeah, I'm sorry. Let me go to indicators here. I want to talk about sentiment for a little bit. This chart is the AAIIS allocation survey. So we've got the blue line at the top, which is the percentage that is allocated towards equities. We've got the green line, which is allocated towards bonds, and the red line, which is allocated towards cash. And one of the things that we've seen is that equities, the percentage of allocation towards equities is getting up to the levels that are often but not always seen around market peaks, and the percentage in cash is also very, very low, typically aligned with what you see at peaks. And you can look at that on a percentile basis. We're pretty low in terms of the percentile basis in cash, relatively high in the percentage of stocks on a percentile basis, so I would point that out. And then in terms of the overall sentiment, market sentiment, that also plays out in terms of the bullish and the bullish sentiment and the bulls minus bears spread. One of the things that I pointed out in my newsletter last Sunday was that bearish sentiment had fallen pretty precipitously to last week in the 15th percentile, but the only thing that was missing, you can see if you look at neutral sentiment, we still had a pretty, we were in the 55th percentile in terms of neutral sentiment, and so the bullish sentiment hadn't seen a pickup in the same way that in the same way that bearish sentiment inversely came down. This time we did get a kick up into bullish sentiment. We're now in the 91st percentile, and so then on a spread basis we're also in the 91st percentile, which is at levels that are associated with the beginnings of market corrections. And so I think that that's something to be aware of. So again, from the start, I would just say that from a technical standpoint and from a sentiment standpoint, we are ripe for a correction. Now, what could actually be a tailwind for risk assets? So if we look at breadth in the market, which one of the things that I look at is the percentage of stocks above their 50-day moving average, and breadth is still in normal ranges. In fact, if you look on the right side of the screen, you see all of these different equity breadth readings, all greens, which suggests that actually, even though the market was down on the day, both in the NASDAQ and in the S&P, you actually saw more stocks rising, compared to their more stocks going above their 50-day moving average, above their 200-day moving average than not. The only difference was the NASDAQ, which actually saw a decline today in terms of stocks below their 50-day moving average, but conversely had the number of stocks going above their 200-day moving average go up. So breadth is actually still pretty strong, and so I think that tells me that there is room to continue going. Another thing I want to look at is the dollar. Let me put my tide indicator on. I was expecting the dollar to be strong this week with the various labor market data coming out. Obviously, that did not happen, and so we did not get the tide cross that I suspected was about to happen. In fact, it looks like price is resuming its downward trend. So just like I said last week, if we were talking about if price on the dollar comes to the upside, then we're going to get that cross, and then we're going to be looking at potentially revisiting the most recent swing high, which is between 106 and 107. But if price comes down, then we're going to be looking at targeting the lows, obviously from the beginning of the year, and potentially even the low, which was just under 100 from back in July of last year. So that's going to be something to watch out for. Now, we do have the CPI report next week, in the middle of the week, and that has the potential, if it's another hot reading, to change this trend back to the upside. But obviously you can't pre-position for it. You have to wait for the data and for the market response to tell you what to do. Simultaneously, we actually got a recross to the bearish side on the 10-year yield. Again, I was not expecting this to happen. My base case was that the bullish tide cross that we just had was going to be a harbinger of things to come, in that, again, the employment data I was thinking would actually lead yields to be priced higher, and that obviously didn't happen. Again, CPI can play a role in this. If you remember what happened last month on the 13th of February, yields backed up 13.7 basis points on the hot CPI reading. So another hot CPI reading could bring yields back up. But again, right now it appears that yields actually want to go to the downside. So we got a bid in bonds on a day when stocks were broadly down, despite having started to the upside. So that's interesting, but again, with the dollar and yields going to the downside, that actually provides support for risk assets, and also generally reflects easing of financial conditions and greater liquidity in the system. And I think that the greater liquidity in the system is shown through the direction that gold has taken over the last week. This is pretty wild. I'll talk about this in just a second. And then Bitcoin, despite having reached its all-time high at the beginning of the week, or reached a new all-time high early in the week, sold off, and then came back up to the upside, and actually today made a higher high, sold off, came down, and then still ended up closing at near its all-time highs. And so Bitcoin is the most reactive to liquidity, and so this, to me, the gold and Bitcoin charts are suggestive of what's happening in the dollar and yields, and that tends to be much more supportive of risk assets in the near and medium term. So that's something to be aware of as well. So on the whole, there are things that can continue to push risk assets to the upside. However, the base case here, because of what's happening in the market leadership has been generally semiconductors, and the outside reversal day, to me, suggests that there is a little bit more downside to come. So I think on equities, the near-term direction of markets is probably more likely to be down than up. Right, and then on the weekly chart, I actually put out a poll on Twitter where I said that markets are currently down on the week. Where are they going to end? Are they going to end higher? Are they going to end green, unchanged, or red? And it looks like the market close. At the market close, we actually ended close to unchanged, but slightly red, and then down on NASDAQ, up on Russell. So that was kind of interesting. We're seeing, again, a mix of results in the equity markets. So that's kind of, I think, where I want to leave it for today. I think it's safe to expect some downside. Obviously, things don't go in a straight line. I'm not telling you to short the market here. Shorting in equities particularly is kind of a fool's errand. It's so hard to be profitable to being short equities. Because, I mean, like you see, obviously in the 2022 bear market, you can see how the upside moves during the bear market were just vicious. And then, like, how many different people have been trying to short this market all the way through and just getting steamrolled. So you have to be really careful. I think if you're long already, if you haven't already, then you'll definitely want to be setting hedges, or maybe closing out or taking some profit at least on some of your positions. And then if you want to, and then if you're not in the market, then you should be looking for the opportunity where the market signals that if this is indeed a correction, you'll be wanting to watch for when the market is signaling to you that it's time to go back to the upside. That way you can establish a position. And actually, I know that there are, maybe I'll leave you on this note. I know that there are a lot of people out there that have been on the sidelines watching this rally. Everybody's anxious to get in. So many people continue to say how expensive and overbought it is. And really, I think, honestly, everyone is dying to get in because everyone knows that this market is going to go to the upside. And so with that as a backdrop, I think if this does indeed start to pull back, then the developing risk that you'll have to be aware of is that either it won't go down as much as everyone suspects it will, or it'll blow through where everyone expects it to hold support. So obviously you got to be aware. That's why you have to have a process and a set of signals that will help you to find when the time to go long again is. So I'll leave it at that. Thank you for tuning in. Don't forget to like and subscribe. I'll see you guys next week. Have a great weekend.